So I'm calling this project, my next book project really, the Berkshire Model, Beauty and Blemishes. And so far it's based on 2 research papers, one stressing the beauty, the strength, the strong features of the Berkshire model, and the other addressing the blemishes, the weaknesses, the drawbacks. And that second paper Jason Zweig referred to this morning. They're both, one was just published in the Wake Forest University Journal. It's available online for free. That's the one about the strengths. The other one I'm still working on, and the blemishes piece, it's a little harder, and Jason read it in draft. But it will be published by Columbia University in the spring, probably right in time for Berkshire's annual meeting. So I just want to highlight a few of the strengths that emanate from the partnership model, and then highlight a few of those blemishes, and then take a look at the future. So on the strengths, in the acquisitions arena, Berkshire has saved enormous amounts in fees and other costs by waiting for the phone to ring. As you heard this morning, as you know, Berkshire does not go out looking for acquisitions. Sellers of businesses come to it through their advisors, through people they're paying, including Byron Trott at Goldman Sachs. Most firms, most companies design acquisition programs with in-house acquisition staff, and they design strategic plans about what they're going to look for and how they're going to get things. They hire business brokers and investment bankers to do the hunt. Those people they charge fees, and they have incentives to get deals done. Most companies also hire platoons of professionals to conduct due diligence on businesses, accountants, lawyers, consultants, and others. Berkshire has never done any of that. It has never had a strategic plan. It never has an acquisition profile. It has never hired a banker or broker. Berkshire has never hired a banker or broker to do an acquisition. It does very little formal due diligence. A law firm might do in a small, short profile. But mostly, Berkshire relies on itself. Warren and Charlie rely on a network of friends and business associates for deals to come to them. Their gargantuan daily reading equips them with business knowledge sufficient to evaluate most transactions that come to them, and they've exercised great discipline in defining their own circle of competence, so they pass on deals they don't understand. Second, financing. Berkshire has likewise spared its partners considerable expense in relying almost entirely on internally generated funds and insurance float to fund its operations. It's borrowed sparingly, to use Warren's word. Provided insurance is underwritten with discipline, that float, the premiums held, received up front, before claims have to be paid later, if at all. As long as that underwriting process is disciplined, the cost of leverage is zero or can be negative. And Berkshire has been phenomenally successful at exerting discipline in insurance underwriting across all of its businesses. Today, float at Berkshire exceeds $85 billion. This is other people's money, but without due dates, without covenants, without the hassles of bankers, the cost of negotiation. Within Berkshire, some subsidiaries generate more capital than they have uses for it, and others have the opposite situation. All the subs with excess capital send it to Omaha. Those who need more capital call Warren. It's much easier dealing with Warren. He's the friendliest banker you can imagine than it is trying to negotiate a commercial loan. Third, on the corporate board. At most companies in corporate America, boards have become expensive bureaucracies. Directors monitor managers. They oversee them, often second-guessing them. They meet often, as much as every month. They hire consultants, accountants, lawyers, and others to help oversee managers. They're paid very well, easily 6 figures at the larger American corporations, and they enjoy considerable stock option compensation, plus liability insurance purchased by the company. Berkshire's board is like an old-fashioned advisory model, a pure partnership model. They're friends and family who are there not to monitor management, but to partner with it. There are few committees, no hired advisors, and 1, 2, 3 meetings a year. They are paid token sums. They are given no stock options and no liability insurance. But they're all considerable shareholders of Berkshire, and they bought the stock with their own cash. Fourth, owners. We had a whole panel on owners. Most American equity is owned by institutional investors, hedge funds, mutual funds, pension funds, and so on. Stock trading is frequent. Portfolios are rebalanced often. And diversification is really important, far more important than any notions of loyalty. As suggested on the panel with Tom Russo and Whitney Tilson and Paul Lounces, the typical, and maybe you know you yourselves, the typical Berkshire shareholder is very different. It's family, people, human beings, or family offices, or firms that specialize and cater to that kind of clientele. The holding period is very long. Turnover in the stock is very low, especially for a company of its size. For many shareholders, Berkshire is their single largest holding. Many shareholders of Berkshire are not interested in typical investment diversification. Most shareholders at most companies don't bother reading the annual reports and scarcely attend the annual meetings. Berkshire shareholders devour the annual report with alacrity, and they take it apart. As John Phelan has said, they just deconstruct it. It's the most intensively read and evaluated document in corporate America, I say. 38,000 people attended the Berkshire annual meeting last year. On managers, most corporations have centralized procedures, departments, consultants, oversight, rule books, second guessing. Berkshire has none of that. There's no centralized departments other than internal audit function. It just collects the data. There are no hierarchies for reporting or budgeting. There are no departments. There are just 24 people at headquarters in Omaha. All those kinds of functions, to the extent they are needed, are decentralized and pushed down into the subsidiaries, where Berkshire managers have unbridled discretion to run their businesses and set their strategy as they see fit. I've talked to many of them, including Bruce Whitman happens to be here. Bruce, I don't know if you mind saying hi, but the head of Flight Safety, a company that Berkshire acquired 20 years ago, is here. Bruce helped build that company. He knows it inside and out. Warren may know a lot about it, but Bruce gets to call all the shots at Flight Safety. That's true across all 60 or 80 of the subsidiaries, the number of areas depending on how you count. Warren sends those CEOs a simple letter every 2 years with 6 simple mandates, very clear and simple. Do nothing that harms Berkshire's reputation. Adopt a long-term outlook. Nominate a successor. But other than that, it's up to the managers to run the business. On reputation, Buffett urges those managers to think of one guiding idea. It was quoted this morning. Do nothing you would not be happy to have an unfriendly but intelligent reporter write about on the front page of your local newspaper. He's been saying that since 1991 when he served as chairman of Salomon Brothers, a reluctant interim chairman to help rescue that firm that was bedeviled by a criminal bond trading scandal. And it was then that he also implored that team of bankers with another great adage that Warren repeats all the time to Berkshire managers and to the employees alike. Quote, lose money for the firm, even a lot of money, and I'll be understanding. Lose reputation for the firm, even a shred of reputation, and I'll be ruthless. And that kind of informal hortatory can be a lot more effective for a workforce than the typical internal controls, oversight, and bureaucracy so common across the rest of corporate America. And finally, on the pluses, Warren is well known as a long-term investor, but a far more profound and important point about Berkshire and its time horizon is that it is forever. Unique among its rivals in the acquisition market. It has not sold a subsidiary that it acquired in the last 40 years. And it pledges not to do so unless a business is absolutely doomed. And some Berkshire businesses struggle, but that commitment to permanence, to forever, is unbreached. And in his missive to the managers, one thing he tells them, again, quoted earlier today too, think about your business as if it's the only asset your family owns and that you have to own it basically forever, for 50 years or 100 years. Berkshire's sense of permanence has enormous economic value to sellers of businesses who are seeking a permanent, comfortable home that Berkshire uniquely offers, whether that is a family business looking to secure a legacy or an entrepreneur simply eager to have capital and freedom to develop a business she's passionate about. The value of corporate culture cannot often be readily measured, but the value of Berkshire's partnership culture can be measured again and again and again, and I did it a half dozen times in the Berkshire book, by the discount sellers have accepted when selling to Berkshire, because they value the intangible features of the culture, especially autonomy and permanence.